Hey, welcome back to the channel. Thank you so much for coming back here to Shake Hands with Destiny. That's right. Where our whole thing is where we talk about faith and finance, y'all. Why do we do that? Because our whole thing is eradicate hardship, stimulate lives, right? And I only shake hands with my destiny if you shake hands with your destiny. So let's get it. Let's go. So I've been getting a lot of questions about real estate. Even though I'm not a realtor, I'm not in the real estate game. I talk about faith and what? Finance, right? And we have to understand one thing, y'all. One beautiful thing. 2 out of 3 people in this country are living check to check, and they're one hardship away from breaking point. However, the top 1% is where it's about. And I want to talk about here today, and what our whole channel is about executing like the 1% of the 1%. But it's not about the things that you know, it's about learning the things that you don't know and then executing on them. So what I want to talk about is what you call the debt service coverage ratio loan. Okay. Well, technically, it's not even a loan. We call it the DSCR loan. Technically, it's not a loan. It's just a ratio based on how the lenders uh, state that you're covered for the ratio for how you're approved for a loan. Okay. And I'm going to tell you something. We're going to talk about Shanika here today. Shanika is our guest. She just bought a house, got her credit up and going. She's now at a 710 credit score. Just bought that first house. Beautiful thing that you can buy your first primary home. The worst thing that you can not do when you buy your first home is not buy another one. Our world is set up for the investors and the wealthier and the 1%. So what we're going to talk about here is talking about that DSCR loan. What are the advantages? What are the pros? What are the cons? Okay. So she just bought her first house, right? Single mom, got a job, all of that good stuff, no major money. So what is the big benefit to these DSCR loans? What a big benefit is, you know how Shanika, you just went through buying that house. They asked you for everything under the sun and some. You couldn't get $5 out of your bank account, or they was like, where did that $5 come from? The beautiful thing is with the DSCR loan, guess what? You don't even need a job. You don't need to prove your income. Whenever you're looking at properties anywhere from 1 to 4 units, meaning a single home up to a fourplex, you don't need to do anything as far as showing proof of income. However, it is based on your credit. You can have credit scores as low as 620, but of course, the lower your credit score, the more money you have to put down. The money put down is anywhere from 15% generally to 30%. Okay. And we're going to talk about that here in a moment. Okay. So again, do you have to show any income? No. Because remember, Shanika, she just bought her first home. She barely qualified for that one because she had a car note, she had student loans, she had all of that good stuff, just like anybody else. And in fact, she was able to get what you call an FHA loan. So she only had to put 3.5% down. Great. Okay. But really, could she qualify under the traditional quote unquote Fannie Mae or conventional loan and they prove her income? She couldn't do it that way. So this is the benefit of a DSCR loan, okay, or the ratio that's being used. Now, this is how the ratio is being utilized. It's not based on your income, it's based on the income or the projected income of the actual asset. What that mean, Corey? In this case, we're going to say Shanika's going to buy what you call a duplex, okay? And that duplex, whether it's rented or after she gets the appraisal, it's going to be based on how much can it rent for it, okay? So in this case, we're going to say she's going to buy a duplex, and it's $200,000 for this duplex, okay? Um, and in this particular case, the mortgage is going to be we'll talk about the mortgage here in just a second here, because I did a ratio here. Let's just say sometimes the DSCR loans, though, the interest rate can be a little bit higher on that particular loan. So let's just use for mathematical pra- practical purposes is 8%. Okay. So what's going to happen is anything over that 1%. And what happens is you take the net income divided by the mortgage payment, and that needs to be 1%. Anything above the 1%, you're then eligible. So what means you're eligible? So what that means is if the rent was, just using this as an example, the mortgage plus taxes plus insurance plus taxes, insurance, and if you have a homeowners association, they count all of that into the equation. Let's just say the mortgage was $2,000 and all of that came out to be 2,000. It would be then 1%, so it would qualify, right? The next part of that would be, and I'm going to give you a real example here in a moment. The next part of that was she. Remember, I told you her credit score was what? It's a 710, so she's already qualified. She just needs the 20%, right? You're probably going, where's she going to get $40,000 from? That's where I come in, okay? But let's use the math here. At $200,000 at 8%, her principal is going to be $16,000 for the year. You take that amount, divide it by 12, you're going to come up with $1,333. And I need to do a part 2 on here so I can show all the graphics on this, and I'll come back and I'll do that. Let's say the taxes on that is $2,400 a year. You divide that by 12, that's $200. Let's say the insurance is $2,400. Again, I'm only using this for mathematical practices, okay? It's $200. So all of a sudden now you have the principal was $1,333. Insurance was $200 a month. And then the taxes were $200 a month. In this case, there is no homeowners association in this case. So her total mortgage is $1,733. Okay. So the rent, what she's going to charge for rent is $1,200 per unit. Okay. She matter if she goes Section 8 or just whatever she's paying, $1,200 a piece. So what's the totality there? The total was now $2,400. So you're going to take $2,400, which is her rent payments. That's how much she's bringing in from her rent. You're going to divide that by her mortgage, which is $1,733 when you add the mortgage plus taxes and insurance. That's going to come out to 1.38. What is that? That's above the what? 1%. So the mortgage company is like, yeah, you qualify for this thing, right? That's right. Now, what has to happen now? As long as if she had a lower credit score, such as a 620 or a 640, where some lenders would approve, that her overall down payment could be a little bit more. Her loan to value may be more, meaning she could have to put 30% down. But because she have a 710 credit score now, because she's been working with us here at Shake Hands with Destiny, she only has to put anywhere, we're going to say 15 to 20%. We're going to use 20% as the ratio here. Okay. So in this case, she has to come up with what? $40,000. So now she has to come up with $40,000, right? And then you also want to have expenses in case 3 to 6 months worth of rent. In case someone moves out, they will look at that as well. So in this case, she needs to have about 6,000 ish or so dollars in the bank after she pays her down payment. Now, what is the beautiful thing, y'all? What's the beautiful thing? I'm gonna come back to how she's gonna get that $40,000. Here's the beautiful thing. That 1.3%, guess what? She can do just an interest only payment where she's only paying the interest. They do the ratio there. You can do what you call a cash out. You can do what you call a fixed 30, or you can do a 40-year interest. And yes, keep this in mind. So you have all types of different ways that you can actually do this. So she can actually go back, take her money right back out of this. So in this case, what she's going to do, just like I did for a couple of people already, is I got one person $50,000, as you can see here. I got another person $75,000 on what you call a business loan. Here's the beautiful thing. They don't care where you get the money. So technically speaking, you can go get what you call a business loan. Even if you're just a sole proprietor, that's the common things that we teach. And so now all of a sudden she has that $40,000 to put down on the house. Okay. Just like I help some other people also in real estate, which is not on her personal credit either. Can you also purchase this home as a business or under your LLC? The answer to that is yes. So maybe Shanika wants to partner with two of her friends or two co-workers or two family members, what have you. You can actually partner and purchase this under your LLC or under your business name. What's the benefit there? Then maybe she only has 20,000, but the other two people have $10,000 apiece. So now you can put all of that together and now you have an investment property. Because remember, how much is this cash flow again? If you go with just an interest payment, she's only paying that the interest only. Your cash flow is almost $1,000 at that point per month. So you're getting, so it just depends on if you want to take an interest only and you want overall cash, or you want to take a 30-year or a 40-year interest. Depends on what you want to do. Okay. There are some penalties. I will tell you that. There are some penalties if you decide to pay off the loan prior to 5 years. So keep that in mind. So if you decide, can you go back and refinance? Yes, you can. But here's the beautiful thing. Say, come on, Corey, tell me the beautiful thing. This is set up so all you have to do is rinse and repeat. yes, you can actually go right back because there is no amount of homes that you can use. So you can go back and do this 5 times, 10 times, 20 times, use this exact same formula. So guess what? Guess what? She can go back once she comes up with that first $40,000. She can now use this again on the second house by taking a certain amount of money out of the first property, taking that cash out and using it towards the second property. As long as that first property can sustain the amount that she takes out, meaning the rent can cover the amount that she's taking it out, and your ratio is still above 1%.
Wait a minute, Corey. Did you just say what I think you said? This is how the 1% execute like the 1%.
So what you want to keep doing is you're rolling that money from one house to another. Okay. So then you can take cash right back out, go back, pay off your initial $40,000, and then who's paying the rent on that? Who's paying the 40,000 in the first place? Is Shanika paying it? No. The people that's you're renting the home out is actually paying it. So in fact, that same $40,000 could have purchased 3 homes because you're just going from one house to the next house. Okay. This is how you execute like the 1% of the 1%. And another thing, what you can also do with this here, give me just a second here. I wanted to tell you this here. You even if the home is not rented out, okay, and I think I said this before. Let's just say it's not rented out. This even has it built in where maybe you have to do some upgrades to the home. Not a problem at all. Maybe it's going to take a couple of months to get that house rented out. Not a problem at all. You can still qualify as long as you're going within 1 to 4 units. It does work slightly a little bit different when you start saying, "Hey, I want to buy an apartment complex and it's $2 million," but the principle still stays the same. It's based on the assets of the actual purchase of the asset that you're purchasing at that particular time, i.e., if you were buying $1 million property and it's bringing in $1.2 million, it's above that 1% ratio. So, this again, let's go back to what Shanika just did. She just purchased her first primary home, and they had to make her jump through all types of hoops to do what? Purchase that. She had to come up with all of the money. They had to show where the $5 were, where $10 were, who gave you that money. The beautiful thing with this is it doesn't matter where the money comes from that you put money down. You can have it from a family member. You can have it from someone that's in your business as well can give you that money, as well as the expenses that, remember I said the expenses that need to stay in your account anywhere from 3 to 6 months worth of expenses that also can be given to you by, i.e., an individual. Or what I can help you do is also attain those funds through business funding, credit funding, 0% funding. Because here's the catch: you can go do $40,000 at no interest on that, and you can make that no interest essentially be 3 to 4 years of 0% interest, and you just pay that amount, and you still have $40,000 on a credit card. Let's just say at no interest, you paying a couple $100 a month on that, and you still netting $1,000. Now you go multiply that times 4 different properties. What are you going to come up with? Now you're netting almost $1,000 per property. That's 40. That's $4,000 per month. That's $50,000. Guess what, y'all? That's what I call passive income. That's how you execute like the 1%. Hey, if you like this content, go ahead and like and subscribe to this channel. We're gonna be dropping a lot of fire content on faith and finance. Why? Because I only shake hands with my destiny if you shake hands with your destiny. Let's get it. Let's go.